Well, welcome everybody. Steven Sitkowski here. Glad to have you for this week's edition of Market Insights. It is September 8th. We got lots to talk about. Hope you all had a great weekend. I know that I did. It was splendid. Weather's great. Just a whole lot of fun. Anyway, hope you can say the same. Well, as always, we need to start off with a little disclosure. Quick reminder that this is designed for educational and informational purposes only. It is not to be construed as investment advice. So, with that, let's get to it. The NASDAQ hit a record high this morning. So, in spite of all the exogenous events going on, technology just keeps marching. The markets have just kept marching, in spite of tariffs and labor market, inflation, uncertainty with the Fed. We just keep moving higher. And we're in September. So it'd be interesting to see if we can pull off a winning month for September. Labor markets show definite signs of weakening. I'll have a little graphic for you. I don't know that we're at a crisis in the labor market. I will tell you that confidence level for getting a job, it was a survey done out of New York, is at the lowest levels since the pandemic. That's pretty weak. And we've seen unemployment tick up to 4.3%. Job creation almost non-existent for the last month. I mean, really, really weak. Initial jobless claims spiked last week, so definitely we need to keep an eye on that. PPI, that is inflation at the wholesale level. CPI, inflation at the consumer level, will be announced this week. So we're hoping that those are under control. Everything is set up to get a rate cut on the 17th of this month. Now they're talking about maybe 50 basis points. I don't think that's going to happen. It's certainly not off the table. I think they're going to want to ease into this, especially because inflation is still too high. 10-year Treasury, in anticipation of lower rates, has come down almost 4%. Market's got to love that. And oil prices are pretty steady in the low 60s. So for last week, the big winners, I mean, all of them at the top were all AI related. Western Digital, Broadcom, Seagate Technology, Micron Technology, and Alphabet, formerly Google. And then you've got in the builder space, builders first. I mean, with interest rates coming down, we can expect to see more and more construction. I think there is some opportunity in the home builder space, but builders first source was up 7.5%. Williams Sonoma, you got to put stuff in those homes. Clorox, you got to clean them. And then D.R. Horton, there's a home builder. So it's either building or AI that led the charge. So in anticipation of a rate cut, I'm going to tell you where there might be some opportunity. It's an area that's a little higher risk. That's Russell 2000. So when you look at these smaller companies, keep in mind a lot of them aren't even profitable. Some 40% of the companies in the Russell Index, they lose money. Not that they necessarily lose money forever, but they're losing money now. But let's look at the days before and after a rate cut. After holding for 3 months, which we have done. The wild card, of course, is a recession. I don't see a recession, even with the weakening labor market. That'll take time to filter through, and it could just be temporary. But you can see, the green here, if no recession, the markets really respond in a very positive way to rate cuts, assuming what? that the economy holds together. Job market looks to be in real trouble. So, for the first time in a long time, the unemployment rate is now greater than the job openings. More people looking for work than available jobs. And that has not been the case for years. So, again, something you definitely got to keep an eye on. What you'll be watching this week in terms of announcements. Well, the biggies I've already mentioned, but today we've got consumer credit numbers coming out. Is that going to move the market? No. Tuesday, small business optimism. Is that going to move the market? No. It's expected to tick up a bit. On Wednesday, producer price index. So that's kind of a big deal. Expected to move up 0.3%. Last month, it moved up 0.9%. I think that was tariff related and front loading to try to avoid the tariffs. It'll be more normalized this time at 0.3. Core PPI, so that removes energy and food from the equation. There's not a forecast on that. And year over year, PPI on the last report was up 3.3%, which is well above the targeted rate. We really want that in the twos. The Fed wants it at 2%. So that's our target. And then on the consumer side, we're expecting a tick up from 0.2% last month to 0.3% this month. And year over year, moving from 2.7 to 2.9. And then the core remaining steady at 3.1. It's going to be tough for the Fed to do what it wants to do relative to interest rates, given this inflationary environment. I know they would be much more comfortable cutting rates if inflation were more like 2.5% as opposed to closer to 3%. Last week's heat map, you see a couple of huge winners. Broadcom, Alphabet. Alphabet got a favorable ruling regarding their antitrust. I think they can thank ChatGPT for that. They can go, hey, look, here's a competitor. We didn't do anything to stop them. So I think they owe that to them. So they moved ahead nicely. Oracle up 6.5%. Energy sector down. Oil is kind of stuck. Barrel of oil it's been about the same level for a while, the low 60s, which is fine. The refiners make money there, but it's not like a windfall. They prefer it over 70. Market sentiment. Now, this is kind of interesting. So we have markets at an all-time high. You would think people would be euphoric about it, but they're not. If you look at what's historically, when they ask independent investors, where's the market going over the next 6 months, 37.5 say higher. Right now, we're at 32.7%. Historically, 31% say lower. Now we're up to 43.4%. So I think people are kind of sniffing. There's a problem out there. Now, I think a lot of it is driven by the media and they over exaggerate the problems, but the data is the data. So you have sort of bifurcated information, market moving higher, jobs market moving lower, and delinquencies on revolving credit now are at 14%. That's huge. So you got a lot of people falling behind. I think you can blame all that on inflation. Now, will the lowering of interest rates help to alleviate part of that problem? Because in theory, the bank should reduce their rates. Of course, there'll be a delay. They're going to want to squeeze it for a while. Or do you ignite another round of inflation? So it's kind of a tight wire act that the Fed's got to play if they're really looking out for, the middle class and the lower middle class. This week's earnings, not a whole lot that I think can move the market. Maybe Oracle, that could be potentially a market mover. Maybe Adobe, but I don't think you're going to see a big change in the stock market. We sort of have a vacuum right now as it relates to catalysts. We don't really have a catalyst in this. It's not earnings. I guess the Fed's closest thing that we've got close up. All right, let's take a look at the charts. So on the S&P 500, we'll use the SPX, which is a proxy for the S&P. S&P consists of 500 large cap stocks. So a couple things I always like to look at. This yellow line is a 50-day moving average. It is sloping upwards, which is bullish. We are above that 50-day, which is bullish, but we're not too far above it. You start getting too far away, whether it be on the downside or the upside, then you tend to have the market want to move toward that 50-day. We're just about where we should be. Everything looks real positive there. If we want to look at the Qs, more of a technology play, with the Nasdaq at an all-time high, again, that looks pretty nice. Notice how the 50-day is acted as a support level. So that's really positive. So everything there looks good. I'm going to be keeping an eye on the inflation data this week, and I'll be keeping an eye on the jobs market. Those are the two things that I am most concerned about moving forward, and should be on your radar as well. Okay. I hope you have a fantastic week. Till next time, be safe, be blessed. Bye for now.